Andrew here from The Investor's Way, and welcome to Woody's Weekly Wisdom episode number 8. And look, we are going to dwell just another week on the whole interest rate saga, but mainly because there's some more interesting news around interest rates this week, both here in Australia and overseas in the US. So whilst it's relevant, we'll probably keep talking about it. And the reason I have wanted to keep talking about interest rates is, in particular this week and this headline, is that there's a lot to unpack in what it's telling us is coming. And I suspect that this article didn't realise necessarily what it was suggesting when it was written. But there's some really interesting data. You try and say that. Interesting data in this article that tells a story that you probably need to read a little bit between the lines to pick up. So hence why I wanted to talk about it. So this one says the RBA pauses in April as insolvencies pile up. So that is obviously a very supercharged headline, get our interest. And I guess firstly, let's pause and just enjoy the fact that the RBA has not increased interest rates in the month of April. And I understand, and you'll see further down in this article, that the US is also contemplating not increasing interest rates in April. So at last, the banks have, or the Federal Reserve and the Reserve Bank of Australia have finally realised that maybe they've gone pretty hard and it's time to at least just wait and see what happens. And I actually heard an economist during the week describe the way these reserve banks and their governors, how they they deal with interest rates. And he said it's like they're always looking in the rearview mirror. And that is that they'll put them up too far and then have to go back, reverse back to a little bit to where they feel it's a little bit more comfortable. And they'll when they're dropping rates, they'll drop them too far and have to reverse course a little bit to get to the happy medium. And you would think with history and data and technology and all the rest available that they could learn by pausing a little bit sooner than they do, but unfortunately that's not the case. But let's celebrate. In April, we've got a pause in interest rates, which is great. So the second part of this article is about the insolvencies. And I've touched on this point in recent content and in these weekly wisdoms, that insolvencies is a bit of a telltale sign. It's kind of like the thing that the banks should be looking at as a telltale. So rather than having to always be looking in that rearview mirror and overshooting the runway all the time, maybe they can use this data to start telling them a story. And when these insolvencies are piling up in the construction industry, that is a massive tell, and one that really is the real story that's going on in this article this week. And what we're basically seeing is the construction industry, for me, has always been the first place where the insolvencies happen because they work on such tight margins, and it's the first sign that things are really slowing down. So when insolvencies start cropping up in the construction industry, it's because people are tending to build less, and or inflation has caused costs to go up so high. And because these construction companies have been working on fixed price contracts, the price of materials has just shot right through their profit margin, and they're now going backwards and leading hence to the insolvency. So this article talks about the fact that the insolvency wave has hit. We've got a whole bunch of companies going into insolvency, led by the construction industry. You can see in this graph, although this little bit here is deceptive because it's only partially the March data, but you can see we've got this big blip from the low to almost a high in insolvencies, and that is a real problem, and you can see the construction industry is a big component of that. So this is telling us that the impact of the interest rate rises are biting, and they're slowing down the economy, and that will then in time filter through to inflation. And in last week's weekly wisdom, we looked at the fact that inflation had been falling, still above where they want it, but falling. And these insolvencies are only going to contribute further to that story, with more and more of the construction companies slowing down. You can see here more than 400 construction companies have gone under since the start of the year, which is pretty scary. And it accounts for 1 in 4 of the more than 1,500 insolvencies since July 2022. So it's definitely a sign that the economy is going to slow down, and that then means inflation comes down, and already that then means that you've got people talking about potential interest rate cuts at the same time as talking about maybe 1 or 2 more rises, and then we'll start to get cuts, which to me makes no sense whatsoever. If they think that they need to put them up and then bring them back down again, how about you just leave them where they are? Yeah, it sounds pretty simple, doesn't it? But for some reason they feel they have to put them up, force that inflation rate down to this target range that they always like to be in, the 2 to 3% target range. It seems to have become a favoured number for most economies in the world. And given that we're up above 6% still, obviously, we need some slowing down. But the other thing is to keep in mind here is, for most mortgage holders, the last 2 interest rate rises have still not impacted your repayments. They still have not flowed through to your repayments yet. So you'll be getting the letter in the mail shortly to say that your mortgage payment's going up, and then you've got another one saying it's going up again, and that is going to put more pressure on the household spending, and of course, in time, it's going to slow down the discretionary spending that is effectively causing this inflation, according to the economists. But I argue that we're in a self-fulfilling prophecy where they're putting interest rates up, which is causing a whole host of essential services to go up, like electricity and things like that. And we get to this circular argument about what's causing what. Is it the interest rates causing inflation, or is it our spending causing inflation? And they're using interest rates to bludgeon us to stop spending, and then all that's causing is our costs to go up. Anyway, another piece of rant there. But with the increase in insolvencies, the 2 more interest rate rises still to hit people's household budgets, then there's still a fair amount of tightening coming. And then on top of that, you've then got this looming global credit crunch, which just means, in layman terms, that it's going to be harder to get access to debt funding, whether it be the banks getting the funding that they need to fulfill mortgages or new mortgages, or whether it's households trying to get those mortgages. It's just generally going to get harder because when rates go higher, just the general flow of cash in the world global economy just slows right down. And when you've got some major banks in parts of the world, like Credit Suisse, who are struggling, that is also going to result in a tightening of lending processes and procedures and the flow of cash. So Silicon Valley Bank was first, then you had Credit Suisse, all creating pressure on the banking sector, which then tightens the lending conditions, which just means it's harder to get access to cash. And then we get into the environment when it's harder to get cash, then people aren't spending, and then we get in the equation where inflation dries right up and the economy slows right down, and the governments are now going to then stimulate the economies. So who'd want to be, in government? I don't understand why anybody would want to do it. It's a mug's game. You can never win. Economies are always doing the opposite of what you want them to do, and there's always these pressures to get the economy working in the direction you want it. So the last thing that I want to say about this article is, again, to be mindful of this, words like contagion risks, very inflammatory, very much intended to scare. This article, whilst not being overly inflammatory generally, it's still designed to drag you in and create a little bit of fear. Ultimately, what we're seeing here with these insolvencies, and I feel very, very sorry for anybody impacted by them, whether you're an employee or a customer of these businesses that have gone out of business. I feel really sorry for those people. However, the bigger picture here is that these are signs that the economy is slowing, which is what they wanted with the interest rate rises, which means the pressure on more interest rate rises is reducing. And hopefully that means we're very close to the peak of this cycle of interest rate rises, and we can get back to some form of normality in the not too distant future. So I don't think we're going to see the low interest rates that we've seen, which were historical lows, but we should see them come back a little bit so that there's capacity for people to borrow, there's capacity for banks to lend under reasonable conditions, and that enables the economy to grow at the rate of 2 to 3% like they want. So, interesting article this week. Certainly some data keeps building up to suggest that we're getting close to the end of the interest rate rise cycle, but still be mindful of the fact that there's a lot of fear out there, and we just need to be mindful of, when it comes to your personal scenario, if you're managing your money and your finances in these times, then that's a fantastic thing, because these are the more difficult times. And keep in mind also that these are the times where most people bunker down and put investing to the back burner. And that might be a necessary thing for a short period of time because of cash flow. But if you have the cash flow, now is the time to really lock in some great gains by taking advantage of the fact that markets are still at a discount. And there is still some pain to come, unfortunately, when a whole bunch of people come off these fixed interest rate loans that are maturing this year. That is certainly going to cause some pain for the large volume of those people. So, I may talk about the property market next week. I was about to go down a path there, but that's a whole weekly wisdom conversation. So we might do that next week. Simply at this point, let's acknowledge that the Reserve Bank has finally, and the Federal Reserve is about to realise that their measures are having an impact. We're seeing increases in insolvencies, which means the economy is slowing down, and therefore we may be at the peak of the interest rate rises. At the same time, we should be taking advantage, if we can, of the opportunities available to us in these times. So hopefully that was helpful and useful. Leave me a comment down below. Let me know what you thought. And I will be back next week. And as I said, I'll probably take a look at what's going on in the property market, because there are a lot of conflicting messages out there at the moment about where we are in the property cycle. So we might have a look at that, and we'll try and dig out an article to share with you in respect to that. But this week, let's celebrate. We got a pause in the interest rates, and hopefully the pain is starting to slow, and we can get back to some form of normality when it comes to interest rates, and obviously with inflation as well. Enjoy your week. I'll see you again next week. Cheers.